All right, so today's topic, why is liquidity, what are liquidity, I appreciate, why is liquidity testing and why is it important? What are the liquidity tests? I should have wrote that. When is liquidity testing apply to mortgages and how do you determine it? So kind of like we'll go through the basic flow of it. Now, liquidity testing is if you talk to an accountant, like my son-in-law is an accountant, and I always joke around as an underwriter, I am a accountant on TV, but I play an accountant on TV, but I'm not one in real life, right? But as an underwriter, you do see a lot of tax returns and you deal with a lot of financial things. So you just kind of get used to like how things work and how they're reviewed. And so liquidity testing, if you're going to buy a business, definitely something you're going to be looking at. You want to see if this business is broke, right? Is very important. But when you go to like Investopedia, here's how they explain it. It's the financial metrics that measures a company's ability to pay short-term obligations, which are things like vendor invoices, your loan payments, general operation bills, and your profit. Because if you're broke, you can't pay your profit. Now, what they do at liquidity testing is basically compare the most liquid assets to the short-term liabilities, and we'll explain all that in better in a few slides. And if you're thinking of it from a purely financial standpoint, the higher the ratio, liquidity ratio, the more likely to pay the short-term debts. Now, let's just kind of put this into a personal thing. If I have $50,000 in my checking account and my house payment for $1,000 comes in, do you think I'm worried about making it at all? Not a bit. If I only have $900 or $1,000 or $1,100 in my checking account and my housing payment comes in 1,000, I can pay it just barely, right? It definitely shows the health of the business. So we're going to walk through and apply, what it is and why it's been so important to Fannie and Freddie over the last so many years. So here's the basic layout of if you're doing liquidity tests. I'm just going to simplify it right from an underwriting standpoint. This is a tale of two companies. Now, if I'm business one and I had $800,000 in sales, that's my gross sales. I sold a bunch of stuff. In the mortgage business, I closed a bunch of loans and my gross, profit on those loans before I paid any expenses was $800,000. But now I got a business. Remember, I've got employees that work for me. I got rent, I got insurance, I got marketing. So I got 800 grand in, I got 500 grand of payroll, and I got 150 grand of operations expenses. So I made 150 as the owner, and I'm 100% owner. So that 150 is my K-1 profit because we're talking about, again, the partnerships, 1120Ss, and this does apply to 1122s, but they have a little different way of paying. So we're not going to be covering that today's webinar. We're going to be talking about it only in the K-1 format. So I got 150 grand. But if I had some debts and I have to pay them, because remember, when you have a debt, you have pre-spent your income. No different than any employee. If I make 100 grand salary and I have no debt, I get my salary minus taxes because the IRS does not care if I'm in debt to my eyeballs, and I get to live off the rest. So if I have 100 grand come in, 30 grand of taxes, I would have 70 grand to live on. Now, I could just spend the 70 grand how I felt, but most people can't just spend the 70 grand because they have a mortgage. So they pre-spent their income. They have a car payment. They have, they owe from a gift. They're trying to save up for retirement. So you can't just spend all the money you have. Businesses are really no different. So if I've got 60 grand in debts because I had a bad year last year, or I'd take a loan out to pay for some expenses or equipment, or, just have to, bolster my reserves, I've only got $90,000 to pay my quote unquote profit. In this business, again, this would be the person or the business that really has no debts. Now, in a business standpoint, that's not uncommon. Definitely a lot less common with people. So the liquidity testing is generally addressing this, but I want to take it a little bit deeper over the next couple of slides. So when you look at the business, this is kind of what it looked like. So this is just a actual live, 1120S. They brought in $2 million. They had some returns. So they actually brought in like a little over $2 million. This is their cost of goods. This is their gross profit, right? This is what they profited. Now, did the business owner make $1 million? No, because they had payroll. They had their own salaries. They had payroll. They had repairs and maintenance. They had rents. They had taxes. You can just go right on down. And at the end, they netted 183,385. So this business made 183,385. Now that's what the IRS is going to tax you on. especially with the pass-through entity, right? Or even 1120. Now, does the IRS care if you owe your credit cards 40 grand? No. Do they care if you have an investor that they said they were a Shark Tank investor and that they were going to, um, you know, give you money for 3 years, but after 3 years you have to pay them back, or they're going to just take your business from you? If that happens, right? Your grandmother could lend that to you. The bank can lend that to you. A lot of different people could lend it to you. So you got to pay them back out of your profit. Now, some people say, well, no, debts are written off before the 183. Well, here's all the things you can write off. And then I have had people say, well, it's in the other deductions. All right, well, this is a live version, 542,075, which is right there, right? So let's see if any debts are in here. Commissions, consulting, credit and collection costs, 88,000. That's trying to get people to pay you back, dues, subscription, gifts, right? So there's no debt allowed in there. The IRS does not let you write off debt. The same way they don't like you go, hey, I got 100 grand in W-2. After I pay my house payment, after I pay my boat payment, after I pay my quad payment, after I pay my 2 car payments, then you can tax me on the rest. That's not the way they operate. They operate on the 100 grand. They get their money first, you get it second. IRS is no different with businesses. Okay. So now people say, well, they wouldn't be able to make it if they were not liquid. Sure. Just like people, they could make it. What happens if you have no money, right? Because you owe so much. How would you survive? Well, you would use cash reserves. You had to sell some assets, get investors, or just borrow money if you could. But if none of these are optional, you're out of options. Now, again, this is always assuming the business is making money. If the business is losing money, obviously, if you're in the hole, you would be burning up reserves, assets, borrowing money from investors or borrowing money from banks. The difference between the investors and the banks is just a loan and no ownership. But investors will say, I'll give you 30 grand. I want 20% of your business. And now you're kind of in the hole permanently with somebody. But, after you've kind of burned these up a few times, you're not going to make it. So if your business is not making money every year, eventually you go out of business. Now we have a kind of a famous example that at 56 years old, I remember when Amazon was kind of a running joke that they didn't make money for many, many years. I don't remember how many, I think more than 10, that the stock kept going up and up, but they were never making any money because they were building the infrastructure. They were writing off a bunch of things, but they are around. And now Amazon's one of the largest companies around, right? So businesses can survive if they're not liquid or in the hole, but there comes a point where this stuff runs out. So this is the theory of liquidity. This is what we're thinking about in the underwriting world. All right. Now, let's go to the guidelines and see how do the guidelines adjusted. Sorry, I just scrolled that too fast. I don't know what's happening there. Let me click the button one time. So it's scrolling 5 times. So Fannie Mae and Freddie Mac is what we're focusing on today, because I'll be honest with you, like FHA, VA, and USDA, they're very vague about this. I don't think they really care. Matter of fact, our system, we don't apply these rules because they don't say anything about it in any of their guidelines. They infer it a little bit, but they really don't enforce it or hold it. So I'm not going to absolutely go out and say they don't care at all, but I've never seen them enforce it. And I think the main reason is you don't get a lot of FHA, VA, USDA borrowers that have K-1 businesses and corporations. They have Schedule Cs quite a bit. They're employed quite a bit. I'm a veteran. I have a loan that's a VA loan. I also own an 1120S and a partnership and some rentals. Right? I have a couple different businesses. I'm just entrepreneurial. Schedule C, right? I think I have 3 total. So I'm a little unusual, right? But the rules just don't apply because I don't think they get enough of it. But Fannie and Freddie definitely see a lot of people with this type of income. So if you dig into the guidelines and you have to read through a few different sections to kind of put together the framework that Fannie and Freddie are requiring you to use. And I use requiring very strongly. It is not optional. So let's start with Fannie because they really have it laid out the best if you ask me. So in B3307, here's the walkthrough. Hey, if you're going to use money from a 1065 or 1120S, that's what our focus today is, which are, partnerships or S corporations, or which also can be LLCs. Look at these words. The lender must use caution. All right. Now, that's a weird way to start a guideline off. How many other guidelines can you think of that they start with that explanation? They don't. So if you want to use partnership or S corporations as qualifying income, you can use the money from the K-1 as long as you can confirm the business has adequate liquidity. So they use this word generically. Now, there's a couple different ways you check liquidity, and we're going to talk about those, but they're like, hey, can confirm, not if you want to, not if you feel like it, not if there's no option here. You must do these things. So now they describe it in the paragraphs below. So I go down a little bit, and what does it say you can do? All right, on the K-1, if you have cash distributions consistent with the business income being used to qualify, then nothing further is needed to do about access or adequate liquidity that you're past. Now, I often, the second part is if it does not reflect the stable history of these distributions, then you could use business liquidity testing, which we're going to show you that too. But I also get people say, well, Mike, what do you mean? Like, so you can use K-1, but you can't use, but you can always use the business adjustments. Well, the answer is no. Business income being used to qualify is clearly defined. And here's where it's defined at. This is the business money, the K-1 money, and the cash flow adjustments. So the liquidity, when they say business income be used to qualify, they're viewing it as number 9 and number 10, which is a combination of your K-1 and your percentage of business zone, right? So these are the sections. The W-2s are not included in that. And the reason being is when you own a corporation, whether it's 1120 or 1120S, you're both an employee and an owner. So as an employee, like Blueprint Solutions that I'm talking to you through right now, I am an owner and an employee. I get K-1 income as the owner. I get W-2 income as the employee here. So I work here all the time. I get a paycheck every 2 weeks, just like the rest of the staff does. I have a salary. I get bonuses, if the company does well. But the better the company does, I make more money in K-1. Now, partnerships, same thing when we're talking about guaranteed payments. So guaranteed payments, are the same as like W-2 wages, right? They're a little different, but the bottom line is I get a share of the partnership percentage, but I also can be guaranteed base pay. And it's not really pay like paycheck pay. It's, guaranteed checks every month, like 1099 checks or something like that. They go on your K-1. And that happens quite a bit. Like if I have 3 partners already and we need somebody and we're accountants and we really need a technology person for our website and all that stuff. And we call up somebody and say, hey, you want to become a partner? Like, hey man, look, I don't know how you guys are running that business. I might quit my job over at Microsoft and I'm making 150 grand to come over you guys and you're bad accountants. And I'm not going to make any money because my quarter share will not be my 150. And the partners can get together and say, well, tell you what, we'll guarantee you make 150 every year, plus you'll get a percentage of share of the profit, right? So obviously that they're going to guarantee that, which lowers the profitability, but that's how that works. So guaranteed payments and W-2s are not part of this definition of business income being used to qualify. Like I showed you, the K-1 and 1120S stuff is separate from where you see the W-2 at. Now here again, back on this business return, we can show it again. We have our gross income, but what's the very first thing deducted? Compensation to officers. This is the officer's salary. So there was 160 grand of officer salary. Now, I don't know the division of that in this particular one. I mean, I do know because I have these returns, but it doesn't really matter. It's included. Before you get down the profit, you have paid yourself your W-2. This is why it has no, distributions really have no effect on this. So just trying to, clarify my point there. Now, there's the W-2 again, separate. See, it's on the 1084, but it's way up in section 1, separate from your K-1 and your business adjustments. Now, Freddie Mac. Now, I'll say, so I'm a part of a couple of things online. I do marketing, obviously, and I'm part of a Facebook group on Facebook about, it's called like mortgage guidelines. And I will tell you, I see it over and over and over again. I feel bad for the people who get advice from there because you'll ask one question, you'll get completely conflicting answers. And I read it as an underwriter, go, well, out of the 21 comments, here's the 3 that are correct. And I used to kind of like, hey, so and so and so are right, but don't follow any of their advice. I'm a 30-year underwriter. And people are like, oh, you know what you're talking about? Okay, whatever. I'm not going to argue with you on Facebook. I'm just going to keep doing my life. Freddie Mac, there is this impression that they do not care about liquidity. And I know where it comes from. It's called not reading the guidelines fully. And I'm going to demonstrate that here. So stable income for self-employed borrowers, right? The current guidelines. And what does it say you have to do? The first thing you must do is you must support the business has sufficient liquidity. Does this say you should or could, or maybe if you want to? No, must. So at the very top of the paragraph, requirements. Number 1, financial, stable and ability to pay their bills, right? That's what the liquidity testing is. Scroll down a little further and it says, okay, so, I cut these up. They're on the same. If you just scroll down on Freddie Mac, it would just show up and it says, okay, if you want to use partnerships and S corporation, you should analyze the cash distributions as one way, right? To establish the financial liquidity and standing of the business. What does it say here? Sufficient liquidity. You can establish it using distributions, or in addition, you can use liquidity ratios. So they give you a couple different ways, but they don't give you an option of not doing this stuff. So it's here. Now, I've had people say, oh, yeah, I see all that, but here's where you're wrong, Mike. When you look a little further down, it says right here, down here, access to business income, ordinary income. You can use it with no further information. Yeah, but you're looking right by the obvious. Business income. How do you define access and use? Well, this is just access. When you scroll down a bit further and go access, and literally 2 inches down, oh, use. Well, so this is just saying nobody needs to give you a written statement that you can use your money from your Schedule C. That's ridiculous. You're the owner of it. You can use it. Nobody needs to give you permission to use your K-1 because it's your personal income. When a business, if you have more than one owner or one owner and you have a K-1, the money transfers, the 183 you saw on the air screen goes from the K-1, from the Schedule K on the business to the K-1, which means you're one entity share of the business, which is 100%. In this case, we're doing, goes on your personal tax returns. So there's no other permission needed. You have it. W-2 income. You don't have to ask anybody's permission to use it. You have it. And then you can use the corporate extra income only if you're 100%. So this is what they're talking about, not if it qualifies, if you need permission to access it. Because you scroll down a little bit further and there's the use of income. And this is the part that people mess up. So I see all this Facebook group, people are like, oh, if they don't have liquidity, just go to Freddie. They don't care about it. They darn well do care about it, right? Very clearly they do. Because I look right here and I see maybe use portion share of income if you have, the liquidity funds or the distributions of income, right? So they go through it too, but the use of business income is what they're talking about here. So back up to it. Maybe use your ordinary income, guaranteed payments, which are carried from the 1065 or 1120, that's through the K-1, right? They're not, the cash distributions are not used as qualifying income, but they may be used to establish business liquidity. I don't know, I can't say liquidity today. I must have to need more caffeine. So you can see they clearly outline it here. Now, look at the Freddie Mac Form 91, W-2 separate from business, right? So look in this section. In the business section, it says, hey, take your K-1 and this and give me a number. What do? They combine the K-1, they combine the business adjustments. So I could have positive 100 grand up here, but take a 20 grand loss down here. That means if I'm 100% owner, I have 80 grand to work with, plus my W-2 wages in the case of a corporation. So this is where, again, where they define about using business access or business income, right? So they're both the same for Fannie and Freddie. That was my point in this section here. All right, now to a little bit further. Now we know it's in the guidelines. It clearly has to be validated. So you're given 2 tests. When you look through, we talked about what? Distributions and liquidity testing. They are both liquidity tests, but they just kind of reference this one a little differently. So if you pass either one, you can use the K-1 business and business adjustments, right? But you have to pass them. So I use this analogy when I look at these 2 tests. If I was being sued by somebody because I owed them money in small claims court or wherever else, what would I do when I show up to court to prove that I was innocent of what I was being sued for? I would use distributions of payment. So if so-and-so said I owed $10,000 to them, and I said, no, I don't. Oh, I'm going to sue you. Well, that's okay, because I've got a copy of the cash check. I would show them, go to court, show them a copy of the check from the bank that was cashed, show the bank statement showing it's cash. That person would lose the court case right away. I evidence distribution of funds, right? No question about it. You can't say I did it unless they could show I bounced it, which that's why I'd bring the bank statement. So I would win on Section A. Now, let's say I wrote a check, to a person gave it to them. This is, I gave it to them 3 months ago. And they're saying, I never got paid. So I have a copy of the check, right? And I would then show my bank statements for the last couple of months showing I have the ability. So, if I showed them, if I'm in court in June of, 2025, and they're like, oh, I'm going to cash this, it's not going to make it, I would show you my May ending statement or my current balance statement showing that I could cash that check. So the second test is the ability to cash the check. I'm just waiting for you to cash it. But the evidence of, my ability to do it or that I did it would win the liquidity test, right? I would show that I could do this stuff. And the part we're talking about could is pay my profit, right? So if we go back all the way up the top slide, pay the profit. So here's where you see that at on a K-1. And I go down here and I look and go, okay, this person got 55 grand as their 30% owner of this particular business. So this Matthew dude got 30%, he's 30% owner, which meant his share of the profit was 55,016. When I look down, I see that 16D, which is a cash distributions, that 16 delta was 61 grand. So I know for a fact he got the 55,016. Now, I know some people ask, well, why wouldn't you use 61? Remember, the guidelines say cash distributions are not income. They're evidence of payment of income. So I know they got this 55 grand to use it. Now, my answer really quickly is, why did they get 61 grand? Because maybe you had some overlap from last year. Some of it's this interest income, which is, separate or whatever. That's fine, right? It doesn't mean you use this. It's just saying I can prove I got the 55 grand. That's test one. This is the cash check example. The second thing is in Fannie Mae, they do a better job spelling it out. So I got their screenshot here. They give you two different tests you could do. This is the one where I'm giving the example of, I go to court, I prove I wrote the check by showing a copy of it and evidence when I gave it some kind of record, and that the person in court suing me just hasn't cashed it yet. So I can do this quick ratio or current ratio. Now, I don't like to use the current ratio. And the reason being is the quick ratio is your liquid assets, quickly liquid assets without your inventory. Because inventory is kind of weird, right? If I run a party store, here's a better example. If there is a AutoZone and Mike's Brake Shop side by side, and we both have $1 million of parts in our buildings, who do you think cares more if there's parts? The person going to AutoZone or the person going to Mike's Brake Shop? You bring your car for me to fix brakes. The only reason I have $1 million of parts is so I come in, I can quickly turn your car back to you. I buy them in bulk. I save money. I know the brands I work on all the time in the year, so I keep an inventory. And nobody cares. Nobody's going to walk back and check and make sure I have the brakes. They just want the brakes fixed. But if I walk into AutoZone and there's nothing on the shelf and they just have pictures of things, why would the store even be there? It's ridiculous. I want to get there, get my car washed. I want my brakes. I'm a do-it-yourselfer. I want my brake pads. So that makes a difference. So if you can prove that the business doesn't rely on inventory, you could use the one in yellow. That's the only difference between these two. So let's show you kind of, again, a real example. So this is that same business. This is the Schedule L right here. This is called a balance sheet. What this is saying is this top portion is all the assets I have at the end of the year, which equal $347,985, versus the reason I have $340,985 down here. It balances. It's 347. That means it's zeroed out. It's balanced. So the guidelines say you can use, quick things that could be quickly liquidated. Well, cash is liquid. Now, the second one is immediate debts are liquid. If I invoiced you 2 months ago or 2 days ago, and it was December 28th, and this is January 3rd, I haven't got the money yet, it would show up here like, hey, this person owes it. It's not a bad debt. I'm going to get it, right? So that's cash as well. But this inventory is the yellow. Well, if you believe this business is not inventory dependent, this would also be cash. Now you have to balance that against immediate debts. Again, think about yourself personally. Let's say today, you have $5,000 sitting in your checking account. More than likely, you can't just go to the casino and blow that $5 grand because you got a car payment coming up, you got a house payment coming up. You're trying to save. You got reasons you've already spent the money in your checking accounts, just sitting there waiting for something. That's what the reds are down here: accounts payable, mortgage notes and bonds, or other liabilities. These are typically shorter term debts like credit cards or whatever. Okay. So I got 163 grand in cash. I only got $26,000 immediate debts. I'm pretty liquid, right? So I can definitely pay my own, I could pay my own profit at the end of the year for sure. So if I didn't have distributions, I would do liquidity tests. So I'm going to pause the screen for just a moment. I'm going to bring over Blueprint here to show you, in our software. So I'm going to demonstrate this in a live practical expense. And you folks that are customers, you're probably used to seeing this. Let me go ahead and reshare this. Okay. So here I'm in Blueprint. I set up 3 businesses. The same 1120 has all the same numbers. Let's walk through this. So what you have to do as an underwriter, our software does it for you automatically, but what you have to do as an underwriter is this: full liquidity test. So I got 1120S. I've got 100 grand of W-2 each year for the last 2 years. My K-1, my business is growing. So I got 75 grand of profit from my 100%, 50 grand. And there's that good old distributions. Well, it's higher. I want to use that. No, these are never income. These are evidence of income. So I just have I got distributions. So this is why I'm passing full liquidity, because I passed the first test. Okay. So I've got my K-1 and my business adjustments. That's 19.5 from down here. So if you look at our software, the way we designed it, 2024 qualification determination. So this column is, I made 75 grand on lines 1, 2, and 3. I have 19 grand of cash flow. That's 94.5. Can I use it? And our software says yes, recommend it. Well, why does it say yes? Well, we have distributions. We kind of put it over here aside just to show we have it. So therefore, we can use the 94.5, and we can always use the 100. So my income is 194,500. Now, in the previous year, I got 59.5 of business adjustments, right? I got 9,500 of this, total of 59.5. And I've got over that distributions. So this is evidence of 59.5 plus my 100, 159. So I do my 2-year average, 14,750. Easy, right? I pass the distribution test with flying color. Partial. Now, this is where some underwriters will disagree, and I hope I made my case why I think this is true. I've got 75 grand of K-1, plus I've got some, business adjustments, my 94.5. Now, this is one of the hardest screens we ever had to build here. Some people see this and go, oh, you guys are using distributions as income. No, what we've done is we said, look, you had 94.5 possible, but your distribution is only 30 grand. So we are going to lower that to 30. So we only know you got 30 grand of it, right? So what do the guidelines say? Evidence as long as it's equal to the business income being used to qualify. So we're going to drop the 94.5 down to 30 grand. So now I have 130. Now remember, I also had a second test we could do. We could do liquidity. So I purposely left the software without liquidity passing. So I'm like, okay, I didn't pass this, and I don't want to use, $10,000 a month. I got to qualify with more. Well, great, complete your liquidity test. So, you saw their screen. So let's just say I had, $160,000 this year. Last year at the end of the year, 125,000. And accounts receivable, I had 5,000, 4,000. I'm not going to use any of their current assets, short-term cash. I'm not going to use inventory because it's like an auto zone. But I got, $40,000 of accounts payable, $30,000 here. Save, calculate, and guess what? Now, if I go back up, so my liquidity test passed right here. What this means is I have $4.12 for every dollar of debt I have. So I pass, because a 1.0 or greater means pass. Now, if I only had, $2,000 in up here in cash, well, guess what? I'm not liquid. I only have 18 cents, or, I think it'd be cents, 18 cents or 0.18. I don't know if it wouldn't be dollar and cents. It's 0.18. So I'm not liquid. I have way more debt than I have cash. I am in debt to my eyeballs, right? I got high DTI, right? I can't make it work. And guess what? Our software goes back and says, well, you can't use this higher number then. We have tried in both methods to get it for you, but we can't. But if it does pass, again, back to the 160, right? Calculate, it will allow you to use it. So this is the way the guidelines are kind of laid out. All right, so that's the partial liquidity. No liquidity, and we get these quite a bit. People email and go, "Hey, you're not using this at all. You know, they got a lot more than 100 grand." Well, they failed all the distribution and they failed all the liquidity. So now we can do about it. Now, again, I see this quite a bit. There's no distributions listed on 16 Delta, and this is generally due to lazy accountants. I don't know what to say. Like, there's no reason not to put in distributions. It's extra work for them to do, and they don't want to do it. There's no legal requirement to do it. So they don't. So, typically bigger, like, obviously I've been self-employed for, well, 20 years something. This business is 11 years old. I had a business before that, I'll be honest, didn't work out and I closed it. And this is, my third or fourth attempt. That's how entrepreneurs are. And we've had the same CPA for 11 years. And she's always put distributions. Even when our gross profit was like 2 grand for the year, I got distributions on my K-1. But let's say you see this, how do you fix it? Well, the first thing you do is go to Schedule L and see if they have any liquidity, right? So if I have this and just no debts, well, guess what? I got infinite liquidity because I have no debts, and so it would pass. So I went from just the W-2 income to all of it. That's possible. All right. Now, a couple of follow-up questions, and we'll wrap it up here. Hopefully, kind of land the plane, and I'll pause and I can answer some questions. But people are like, well, what if you have no liquidity in this previous year? Why can't you use income because they have it now? Well, my response to that is, have you ever had a year where you end up at the end of the year like, man, we had a great year. I was able to put a lot of money away. I saved, I paid off this debt. But then 6 months later, you're working paycheck to paycheck. I'll raise my hand. I definitely have had that. At my age now, I've been saving for quite a while. It doesn't happen as like that. But when I was younger, in my 2 kids, my late 20s, man, I was paycheck to paycheck. There's some months I had to eat pancakes more than I wanted to, but that's just what happens, right? So these are year by year. It would not matter if you had a ton of money in 24 because 23 you didn't have any money. That's why it goes year by year. So that's my answer to that. Now, again, I'm just giving you my opinion. I'm not Fannie, I'm not Freddie. I'm telling you, after 3.3 million loans run through our system and 11 years in business, we see a lot of incomes, and we've had a lot of discussions. And Fannie Mae is one of our clients, and we talk to Freddie Mac all the time. So it's the stuff that we've learned along the way. So if you're going to fix it, what I'd recommend you do is get a balance sheet. So I'm going to pause my screen again real quick, because people are always like, well, what can I do? What can we do to get around this stuff? Can I just give you a current bank statement? What does it matter what they have in 2025 when they were broke in 24, 23? It's not relevant. So we don't want to do that. So let me go back to my screen. So what you want them to do is just give them a Schedule L blank and say, can you fill this out? Now, again, the reason they don't do this, they don't have to. It's not required under certain dollar amounts, but this is extra work for the CPA. Or just have them correct their K-1. You don't need to refile it. All they got to do is say, hey, do me a favor. You showed no distributions. Can you CPA? Again, we want to be a certified financial planner or whoever filled these taxes out, not the borrower. They're not a good third party. And say, I need you to correct this and show the distributions. And I'll tell you the reason, and again, 30 plus years experience talking here. I've had many of, when I was in production, a lot of loan officers, oh yeah, I'll get it. And guess what? I would never see that loan again, because the CPA would go, the reason I didn't fill it out was they're broke. They don't have any money. That's why it's zero. They truly didn't have any money. They had to pay loans and startup money and investors. It's not always because they're, just a lazy CPA, but a lot of times it is. And you can just have them corrected and just have a letter go with it. Like, hey, I didn't include it, but these are true and certified. I validated they actually distributed 61,091. That's the two ways I know to correct it. Or get the last bank statement or multiple bank statements at the end of the year. But that's tricky if you don't do a balance sheet, because I can show you my checking account, but you have no idea what debts were paid. That's why I'd really recommend a balance sheet like this for each year. And again, they're not going to like doing it, but that's what you have to have them do it. So it's been recorded. I'm going to email it by Tuesday. And if you're not a client, you want a free trial of income expert, get blueprint.io. We have a trial. There's a demo and a trial. If you go to trial, you don't have to talk to any of our salespeople. You'll just get pushed through and you get to use it. I think we have it for like a year, and we give you like 50 credits. I mean, you can't use a lot, but you can have it for quite a while. Our next webinar is July 17th. This one is near and dear to me. This is the 10-step method to perfect processing underwriting. I had to put almost because I know it's not perfect. But here's a little guide that, preview what we're going to go over. This is the plan that I was taught in 95 when I was taught to process my own loans, and 1997 as a brand new underwriter. The senior underwriter that taught me, which was a 30-year underwriter at that time, was like, here's how I go through a file, the 10 steps. And this thing has worked for me for decades. This is the way I trained my teams. I still use this today. We train underwriters every quarter, and I'm always going through these steps. Now, we live in step 4 income, but I'm obviously aware of the rest of them. But this will be a nice little webinar if you want a nice overview of how to build a training program for your processors or underwriters, so you increase speed and increase quality at the same time, right? This is the proven method that works. It works over and over and over again. You can use it. I'm excited about sharing it. So, all right, let me go ahead and pause recording because people don't like to be recording their questions. And that wraps it up for today.